Hey everybody, Kevin Shortle here. I put together another short video blog for you. This one I titled The Third Wave. This is based upon an article that I read in DS News. And the article talks about what they have seen as far as foreclosure inventory going through specifically auction.com. So it's not a complete study here, but it brought out some really interesting points, things that I've been talking about since 2009, where we saw huge amounts of non-performing loan inventory. Then we saw a bit of a dry spell, then we saw a little bit of a resurgence, and now we're starting to see this third wave of inventory that is now starting to show the ripple effect of what could soon happen here. So let's jump right into it. Here's the article. The third wave of post-recession distress. And again, you can see it was featured in DS News, one of the publications that I read on a regular basis. So there's the article, and let me summarize what they talk about in it for you. So the first wave of foreclosures that we saw were the risky loans originated in 2004 and 2008. If you recall, these loans were back in the day where you could go in and get a loan stated income, 0% down, 110% financing, pick a payment loan, adjustable rate mortgages, all these high risk loans that were originated in 2004 and 2008 were the first ones to go bad when the economy turned. So no surprise there, no shock there, but this was a tsunami of a wave. That's when we saw upwards of 30% of all the loans going into foreclosure. So no question, there was a massive amount of inventory of non-performing loans just after 2008 when things started to crash. By the way, that wave is still around. There's still 40% of the foreclosures that go through auction.com are from this first wave. Still, that's 40%. Very interesting. The second wave was a smaller one, and that was in 2018 when these hurricane-related delinquencies started to come into play. The hurricanes hit Texas for the most part, and Florida, and some surrounding states there in 2017, 2018. And they did, by the way, they put a little stop on foreclosures and banks enforcing that. But at some point in time, that runs out, and people don't recover as quickly, sometimes financially, to make their payments again. So there was a smaller wave, the second wave. The third wave, the wave that right now we're already starting to see little ripples, is this government-insured loans and privately held loans. This is where these non-bank loans really become a part of the environment we have to look at in the lending world. Those are higher risk loans. Now, I've been talking about this for 3 years now, about these non-bank entities that are doing more loans than the federally regulated banks. And there's certainly going to be a difference between the regulations of a bank loan and the regulations of a non-bank loan. So let's talk about this third wave a little bit here. First of all, the government-insured loans. Now, again, we're talking here Fannie Mae, Freddie Mac, Ginnie Mae, which is wholly government-owned. And then, of course, we have the insurance companies, FHA, VA with guaranteeing loans. All of those, we're looking really at about an overall increase of only 1%. Now, that may not sound like a lot to you, 1%. What's the big deal? Well, remember, again, this is nationwide. So that's a significant enough increase to go, is there something bigger here that's going on behind the scenes? Well, if you look at the secondary categories falling within that, VA-backed loans had a 31% increase of going into default. Okay, now again, this is according to auction.com and what they've seen come through their website. So VA-backed loans, 31% increase, and FHA-backed non-banked loans showed a 17% increase. So non-bank loans, they don't have depositors, they have shareholders. They're doing more loans than banks are doing today by a increasingly larger distance, by the way, but they're still backed by FHA. So it does still have the public at large, the government, backing all of these loans. 17% increase. Now, again, that may not look like something too terribly significant. I promise you it is, because these loans are very similar to the high-risk loans that were done in 2004 and 2008, which was the first wave. Now, people are going to argue a little and say, no, they're not quite as bad as those loans because of this, that, and the other. I'm telling you right now, they are as bad as some of those loans. And they probably will continue to start getting back into these bad lending practices. And the FHA is on the hook for all of those. So again, government reports, going back, by the way, all the way to 2017, in government reports, they have said over and over again, high debt to income ratios, declining average credit scores, and loans with down payment assistance programs are an increasing problem. That's right in the internal government reports. So they're already showing concern, yet nobody's doing anything about it. The high debt to income ratios, the loans given to people with low credit scores, and the nothing down loans back in those 2004, 2008, those were the first loans to go bad when the economy turned. In addition, private loan portfolios, national lenders increased by 3%. So these are non-banks. They have less regulations. They still have regulations, of course, under Dodd-Frank, but less than a federally chartered bank, federally chartered lender, somebody like that. So a higher increase here than what we've seen on the government of 1%. And here's one that was really crazy. I had to read it a couple of times. Private loans owned by mid-market lenders increased by 139%. Now, we're talking here about loans that are going into delinquencies. So there's been an increase of 139% delinquencies of private loans, non-bank lenders, owned by mid-market, smaller lenders. And now again, mid-market still to us, it's a huge company, hundreds of millions of dollars. So that's very, very concerning, and that is right on spot. Now again, all of these studies were based upon the non-performing delinquencies that are going through auction.com. So again, not a national study, if you will, not a definitive, this is everything, but enough of a study to say if that's going on just at this big foreclosure entity called auction.com, well, this is an indicator of what we're seeing nationwide. Having said that, all of this was backed up by a study that's done on the Mortgage Monitor every month. Black Knight Financial Services, September report, this one's referring to, but every month they put out this Mortgage Monitor, and it echoes what we just saw through the auction.com. They're saying this: delinquency rate of 6 months after origination is trending higher. So these are new loans coming out in 2018 and 2019. The delinquency rate after 6 months. So someone got a loan 6 months later after the origination is starting to trend higher. Not a good sign, especially with the economy cruising along as it is, more people working, etc. So it's a little troubling trend that you're seeing there. And there's an upward trend on Ginnie Mae backed loans. Now, Ginnie Mae is the secondary market for lenders. They buy loans. It's wholly owned by the government. So Fannie Mae and Freddie Mac, who do the same things, are what they call quasi-government companies, right? Because they're shareholders, but it's also propped up by the federal government. But there's an upward trend with the Ginnie Mae-backed loans. Guess who the Ginnie Mae-backed, Ginnie Mae as an entity is backing? They're backing these private lenders. They're backing these private lenders, the so-called non-banks. Non-banks do not have the same standards, and they're the ones who are leading the way already. Nothing down loans. Okay? Stated income loans. They're going back and doing some of the same lending techniques that we saw way back in 2004 through 2008 that end up being that first huge wave of delinquencies. So something to keep an eye on. We're not out of the woods yet. We're still working our way through the first wave, and now we're starting to see this build up here on this third wave. So not overall good news for the economy, but as a note investor, that means that we're going to continue to see good inventory levels, which really give us an opportunity to help people stay in their loans by taking these non-performing loans and getting them reperforming as well. We're willing and can do things that, well, let's face it, banks and non-banks simply can't do or are not willing to. Hope you enjoyed this. Look forward to putting together another blog for you soon. This has been Kevin Shortle.